Americans for Fair Taxation presents the Weekly Chairman's Report, written by Steve Hayes, president of Americans for Fair Taxation, and recorded by Bob Paxton, a volunteer with the Florida Fair Tax Educational Association. And now, this week's Chairman's Report.
Hello, I'm Bob Paxton with the AFFT Chairman's Report for Friday, July 10th, 2020. Ordinary and necessary, language only a bureaucrat can love. As we have discussed in earlier reports, one of the principles of a good law is that it must be clear and precise. People must be able to clearly understand what's expected of them and where the line is between lawful and unlawful actions. However, all too often, Congress passes income tax laws that were written in a way that only tax professionals can understand them, or they have terms in them that are so vague and general that two honest, well-intentioned people can interpret them quite differently. An example of this is the phrase ordinary and necessary. Now, ordinary is defined in the Merriam-Webster dictionary as something that would be expected in the normal order of events. Necessary is defined as absolutely needed or required. Now, when people are operating a business, they calculate both their total income and all of their operating expenses. The difference between these two numbers is the amount on which they will pay income and self-employment taxes. Now, in order for an expense to be deductible and therefore lessen the amount of income that is subject to taxation, it must be reasonable and necessary for the business. In Publication 535, Business Expenses, the IRS says, quote, "An ordinary expense is one that is common and accepted in your industry. A necessary expense is one that is helpful and appropriate for your trade or business," end of quote. Sounds simple, doesn't it? Well, a lot of taxpayers, their tax advisors, the IRS, and the courts daily disagree on whether or not something is ordinary, normal, and necessary, required. One real example was a rancher who raised, sold, and stabled horses. He spent a rather large amount of money each year ensuring that his fence was painted and maintained. Rather than having a simple gate at the entrance, he installed one that was very elaborate, containing images of horses. And to complicate matters even more, the rancher spent a lot of money maintaining the road leading from the highway up to his barns and his home, where he had an office that he used to work with buyers. Now, he was very careful to deduct only the percentage of the road maintenance costs that corresponded with the percentage of his home that was used as an office. An initial IRS audit found nothing wrong. None of the deductions were questioned. However, in a subsequent audit a few years later, a different agent denied most of the deductions, saying they were not necessary expenses. The agent reasoned that since the rancher lived on the property, allowing the deductions would be like allowing a homeowner to deduct normal upkeep expenses on a personal residence. The rancher tried to explain how having a well-kept property and road gave people confidence when they boarded their expensive horses with him and when they purchased expensive horses from him. He said this impression made him many thousands of dollars a year on which he paid taxes. The IRS agent listened politely, but in the end came to the same conclusion. The deductions were not for ordinary and necessary expenses. After spending thousands of dollars for a tax professional to make his case to the IRS, the parties compromised, the rancher agreeing to pay $25,000 because of the disallowed deductions and to deduct only 25% of these costs going forward. Now, did the rancher believe he did anything wrong? No. And his tax professional showed evidence that the expenses in question were important in persuading customers to do business with him. However, the tax professional realized that challenging the IRS in court might not be a good idea. It was entirely possible that a court would see things the same way the IRS agent did, and there was no assurance that a judge would side with the rancher either. So in the end, it was just less expensive to settle and forego the deductions. Now, this ordinary and necessary time bomb is ticking for almost every small business. The IRS can come in at any time and say that even though you take calls day and night for your business, you can only deduct a portion of the cost of your cell phone because you also call and text your family from the same phone. Is it worth fighting? Probably not. and most people just find it easier and less expensive to just pay the back taxes and either carry both a business phone and a personal phone to avoid the problem, or just not deduct the cost of their cell phone at all. This type of difference of opinion can apply to a car that's used in the business, but also used to go pick up the kids. It can apply to your internet connection in your computer if you use both for business and to answer personal emails and order personal items online. The Infernal Revenue Code is so full of traps like this that it's absolutely a disgrace and clearly violates the maxim that the law must be easy to understand if it's going to apply to you. In conclusion, some opponents, the ruling class and their minions in D.C., say there would be similar opportunities for disagreements under the fair tax regarding what is a legitimate, non-taxable business-to-business purchase. Now, in all of the 45 states with a sales tax, resale permits are filed by business type, sales volume, location, and a number of other data points in a computer system. This accumulated data allows the state to see if a business is paying a similar amount of tax compared to other businesses of similar size in similar demographic areas. For example, if a retail clothing store purchased items with their resale permit that were not purchased by other retail clothing stores, like more cell phones or computers, for example, the state's computer would identify this and send the case to an examiner. Then, the examiner can ask the store to provide the business reason for the extra purchases. If the store owner can show a legitimate business reason, then there's no problem. But if the store owner cannot show a valid business reason, like the extra computers and cell phones were actually for his kids, the offender will have to pay the fair tax and a penalty on those purchases that were actually made for personal use. Business owners know that under the income tax system, it often takes an audit to uncover abuses like this, so they're often tempted to try to cheat the system. Now, they also know that with a sales tax, any deviations from the norm are a lot easier to spot, making it a lot riskier to try pushing the envelope. Now, is the fair tax perfect? Well, no. There will inevitably be some abuse, but there won't be anywhere near as much as we currently see under the present Infernal Revenue Code. There will also be much less room for opinion in the enforcement of the law or the luck of the draw on whether you're audited. Now, we must never let the perfect be the enemy of the good. The fair tax will eliminate the opinion as it applies to individuals. You just pay the tax at the cash register when you buy things. For businesses, it will be much more difficult to game the system, and with much less cheating and abuse, everyone will assume a much more equitable share of the burden of funding the federal government. So, if you're ready to take a very significant step towards wresting control of your government back from a small group of corrupt people and making it possible for all to prosper, then go to fairtax.org and join us. Then, contact your members of Congress and the President and demand that Congress pass the fair tax, the only truly fair tax.
This has been the Weekly Chairman's Report, written by Steve Hayes, President of Americans for Fair Taxation. Check back every week for news and information about the fair tax, and learn why the fair tax should replace our antiquated federal income tax system. If you'd like to receive a copy of the Chairman's Report in your inbox every week, sign up at fairtax.org.